So risk adjusted discount rate is equal to risk free rate plus risk premium. Expected return you're expecting from that particular project, you will get that return. The cash inflow will be constant in few years. So that situation is called as risk free. For high risk project, the risk premium will be high, and for the low risk project, the risk projects will be lower. Hello everybody, I'm your Divya ma'am, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. I welcome you all for the session 3 on your unit 2, the chapter name called as Risk Analysis in Capital Budgeting. So moving forward, the agenda for today's discussion, conventional techniques. So in the previous class, we have discussed about the other two techniques, that is your statistical techniques. In that statistical techniques, we have discussed about the probability, calculation of standard deviation, calculation of variation and coefficient of variation, and we have also looked into the problems of calculation of coefficient of variation and the different standard deviation problems. In today's class, we'll be discussing conventional technique. What is conventional technique is all about, and you'll be able to know what is risk adjusted discount rate technique and what is certainty equivalent approach and the problems based on that, how the risk can be adjusted by using this technique. Moving forward, conventional technique. So in conventional technique, we have two different other techniques to be studied. So what are those two different techniques to be studied? The first one is risk adjusted discount rate. So suppose you take up a project. So let's say 50 lakh project. So in this project, the cash inflows up to certain level, up to certain years, it is risk free. Whatever the expected return you are required, expected return you are expecting from that particular project, you will get that return. The cash inflow will be constant in few years. So that situation is called as risk free. So up to certain years it will be risk free. The outflow, whatever the cash inflow, whatever we want, will be in a constant rate. But later what happens, up to certain next level, the cash outflows and the cash inflows will become, the returns what we are expecting will not get. So the investors expect more return to take up the risk. So this has to be addressed with the technique called risk adjusted discount rate. So here we'll be studying about the two concepts. One is risk free and the risk that we are taking, for that the investors expect the extra return, that is called as risk premium. So what is risk premium? What is risk adjusted discount rate? Everything will be looking in this particular slide. So risk adjusted discount rate is a first conventional technique. So let us look into that. The use of risk adjusted discount rate is based on the concept that investors demand higher return from the risky projects. As I have told you, if you are investing in certain project, that is 50 lakh project, up to certain years, the cash inflows are constant. You get the return what you expected, that is risk free. But after certain years, due to various variables and the factors, the cash inflows might not be as expected by the investors, as expected by the company. So investors expect higher return, that is risk premium. They expect an additional premium amount to take up that particular risk. So that is your risk adjusted discount rate technique. So this concept, in this, the particular investors expect more return on the higher return on the riskier project. The required rate of return on any investment should include compensation for delaying the compensation plus the inflation equal to risk-free rate of return. So for delaying the return what we are expected, the investors, all the organization, the company, the person who takes up the risk also will expect the return higher for taking up the riskier project. So that is risk premium. So that has to be adjusted. So with the help of a formula, and then calculate what is the net present value. Moving forward, there is a formula for this. So net cash flow, NCF, that is your net cash flow. Your K stands for risk adjusted discount rate. I is the initial investment. So how to calculate the net present value under your risk adjusted discount rate? By net cash flow divided by your discounted rate, risk free rate as well as risk premium will be given in the question. So by taking up that, you will get the amount with that risk adjusted discount rate by referring the PV table at rupee 1. So you will get the risk adjusted discount rate percentage. With that value taking up from the table, you have to subtract from the initial investment, then you will be able to find out the net present value. So this is all about risk adjusted discount rate technique. So it is a conventional technique of risk analysis. So as I have told you, my dear students, risk analysis is very important to analyze, because all the capital budgeting decision is taken based on certain assumptions, because future is uncertain. We doesn't know future, and the assumptions might be wrong sometimes. So there will be risk that is associated in each and every year that the project taken. So for that particular purpose, we need to ascertain and analyze the different techniques of your risk analysis, and then find out by adjusting the discount rate, by assigning the probabilities, by analyzing the standard deviation and the variation, we need to calculate the net present value, expected net present value. Moving forward, conventional technique, again, a risk-adjusted discount rate is a sum of risk-free rate plus risk premium. So how do you calculate the risk-adjusted discount rate? So in your question or in your examination, if they ask you how do you calculate the risk-adjusted discount rate, you need to calculate as risk premium. That is your risk-free rate. Risk-free rate will be given in the question, and the risk premium also will be given in the question. The summation of that, if you do it, you will get risk-adjusted discount rate. Moving forward, the risk premium depends on the perception of risk by the investor of a particular investment and risk aversion of the investment. So the risk premium, what percentage they expect, the investor expects. So that risk premium depends upon the investors as well as the risk taken by a project. Moving forward, so risk adjusted discount rate is equal to risk free rate plus risk premium. So how do you calculate the risk adjusted discount rate? Risk free rate plus risk premium. Moving forward, let us understand in detail what is risk-free rate and what is risk premium is all about. Risk-free rate, it is a rate of return on investment that bear no risk. So, risk-free rate means what? That particular project doesn't require any of the additional risk. That particular project doesn't have any of the risk. The investment, the return, in that return we have a assurance, there is no risk of uncertainty. That is risk-free rate. For example, we have government securities yield a return of 6%, and there that bears no risk. If you want risk-free securities, you go for government securities such as the gold bonds. If you want to purchase, it is all risk-free. So government securities yield a return of 6%. In this case, 6% is what? Risk-free rate. Risk premium. So it is a rate of return over and above the risk-free rate expected by the investors as a reward of bearing an extra risk. So for bearing an extra risk, you expect extra premium amount, extra amount. That amount is called as risk premium. We have an example here. For high risk project, the risk premium will be high, and for the low risk project, the risk projects will be lower. So it depends upon the project. So that is your risk-free rate as well as your risk premium. Moving forward, let us take up the problem and understand what is your risk-adjusted discount rate is all about, how we need to calculate the net present value. So let us read the question. An enterprise is investing 100 lakh in a project. So a person, a enterprise, a firm is investing in a project. How many lakhs? 100 lakhs. The risk-free rate is 7%. So up to certain years, the return is expected. What we are expected? The return is certain. So the risk-free rate is how much? 7%. But after a few years, the risk premium expected by the management, that is 7% for taking up the extra risk, is 7%. The life of the project is 5 years. Following are the cash flows that are estimated over the life of a project. So cash flows that have been estimated during the life of the project up to certain years, the return is expected, that is risk-free rate is how much? 7%. But at the few times, risk premium is there, that is 7%. So these are the expected cash flows for the particular year. Calculate net present value of the project based on risk-free rate and also based on risk-adjusted discount rate technique. So first, what we need to calculate? We need to calculate the net present value of a project, and based on that, we need to calculate the another one is basis of risk adjusted discount rate. So two things we need to calculate here, that is your net present value on risk-free rate, and you need to calculate the risk adjusted discount rate technique based on the answer. Moving forward, the net present value of cash flow for all the years by discounting the cash flow at 7% is calculated as below. So where do you get this discount rate? As I have told you, my dear students, we are following the PV table factor, that is at ₹1. So it is available in the textbook, that is I.M. Pandey textbook, your Khan textbook. So you can refer those last page of the textbook. You will get that PV table at ₹1. So at the particular year with that percentage, if you refer the table, you will get the answer. So number of years is given in the question. We have taken the number of years as well as the cash flow, which is expressed in lakhs. We have taken the cash flows as well, and we have taken the discounting factor. What is this discounting factor at 7%? It is nothing but your risk-free rate at 7%. For year 1, 7%, it is 0.935. And for year 2, 7%, it is 0.873. And for year 3, 7% discount rate, that is 0.816. And next 0.763, and for the 5 year, that is your 5th year, the discounting factor at PV table at ₹1 will be 0.713. Moving forward, present value of cash inflow. How did you get this? Multiplication of this. So if you multiply 25 into 0.935, the present value of cash flows in lakh will be 23.38. Similarly, we have done the calculation for all the years, and the total of present value of cash flow is, the summation of this is 244.34. With that, what we are doing? We are deducting the initial investment, that is 100 rupees. The expected net present value what we have got is 144.34. So initially we have discussed the formula, right? The same formula we have applied here. Net cash flow divided by, this is your discounting factor minus initial investment. We have converted that into table and we have solved here. Years cash flow, discounting factor we have multiplied with that, and we have got the present value, and with that present value we have summarized it and we have got the total present value of cash flows. With that we have deducted the initial investment, and with that initial investment we have got our net present value. So this is how we have to calculate the risk adjusted discount rate technique. We are calculating net present value for risk free rate 7%. Now moving forward, we need to calculate the risk adjusted discount rate technique with risk premium 7%. Now, when the risk-free rate is 7% and the risk premium is expected by the management 7%, to calculate the risk-adjusted discount rate, initially only I have told you the formula. What is the formula? Risk-adjusted discount rate technique is equal to risk-free rate plus risk premium. If you do that, you will get your answer. So, the risk-adjusted discount rate is 7 plus 7%, it is 14%. So, years we have taken, number of years is how much? 5 years. And the cash flow, the same cash flow given in the question we have taken. Discounting factor at 7% plus we have taken at 7% again. So, what is it? It is 14%. 7% plus 7%, it is how much? It is 14%. So, 14% for year 1, it is 0.877. So, 14% year 1 discounting factor, how much it is? 0.877. Similarly, we have done for all the years and we have multiplied cash value as well as cash flow as well as your discounting factor at 14%, and the value we have got is how much? 199.79. With that, what is the initial investment given in the question? 100 lakh. So, 100 lakh, we have taken 100 lakh, deducted 99.75 is the net present value. So, this is how you calculate your risk adjusted discount rate when you are taking up the risk premium as well as risk free rate, that is your 14% discounting factor. Nothing to do with it, just whatever the calculation given, you have to put it in a tabular form, that is your years, cash flows given and the discounting factor which you are referring from the textbook, that is your PV table factor 1. This is the discounting rate that we have got. So, different rates, different value will be put in. So, that value we have taken. If you multiply discounting factor into cash flow, you will get what? You will get your present value of cash flows, and the summation of present value of cash flow will be how much? Total present value of cash flow. With that, if you deduct the initial investment, you will get your net present value. This is under risk adjusted discount rate technique by using risk premium as well as risk free rate. So, this is how you calculate risk adjusted discount rate technique. Moving forward, we have certain advantage and disadvantage. Where we'll be having advantage, on the other hand it will be having certain disadvantages as well. So, it is easy to understand. It incorporates risk premium for the discounting factor. Since we are adding certain percentage of amount, we are expected with the risk. So, since we know the risk, the return also will be known to us. So, the certainty of return will be known to the investor. Limitations we have: difficulty in finding risk premium and risk adjusted discount rate, because as I have told you, capital budgeting decisions is based on certain assumptions, and that assumptions and what risk we are calculating, that might not be accurate for the project, because the real market situation will always be changing. It is not constant, it is always changing. We can take up an example of inflation, deflation. If these factors, the selling price might vary, the profit may vary for the company, and there will be certain regulations from the government, and all these factors or the variables will be affecting the cash inflows to the investor, to the person, to the company, to the organization. So, it is difficult to know those things. Through NPV, net present value, can be calculated, but it is not possible to calculate standard deviation of a given project. We can calculate the net present value. So, more the standard deviation, more the risk. Less the standard deviation, lesser the risk. So, standard deviation is very difficult to calculate under the risk adjusted discount rate technique. So, that's it for today's class. In next class, we'll be discussing the other technique of conventional technique, that is your certainty equivalent approach, and we'll also discuss the problems based on certainty equivalent approach. So, smile is the biggest jewel you can wear. Keep smiling, people. Thank you so much.